Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey everybody, happy Sunday. We're here to help you not just survive retirement. I got to make sure you're thriving in retirement, and that means having sufficient income, growth of your capital, so that you too don't have to worry about the silent killer, inflation. Every single week, it's all about sincere and actionable ideas. Those ideas from investment to cash flow, to tax savings, to estate and legal, to navigating the murky waters of retirement healthcare. We do it all, and we do it well. 833-964-PLAN, 833-964-PLAN. Check us out online, getretiredstayretired.com. That's getretiredstayretired.com. Joining me in the studios, I've got a co-pilot on a Sunday morning. His name is David, one of the lead wealth advisors with us here at VestGen Wealth Partners. And David, we've had this investment theme on this radio program for the duration of the year. Pragmatic optimism. We have an implementation theme we'll talk about later in the show. We call it diversifying your diversifiers. But something that resonates with me is that simple concept for everybody who's out there that not often in life, but certainly when it comes to investing, you almost always get a second chance to do the right thing when it comes to investing. How do you apply that? Not in conversation, but how are you applying that with strategies for the families that you serve across the country?
Yeah, I mean, like you said, we've talked about it for the last several weeks that markets tend to give people an opportunity to go ahead and make that change a second time. Meaning, if you think about where we were back in early April and where we are today, first week of June, the market's overcome almost a 20% drawdown in equity prices. So we're back in the green for the year, couple percentage points off the all-time highs. This is the second chance for investors that probably came into the year a little bit too risky with their portfolios to go ahead and reallocate capital to kind of hunker down, if you will, if they're nervous about what's coming in the future. So I think a lot of this for the families we work with, this was done, in 2024, in Q3 and Q4. But for folks that wanted to stay 100% in equities, now it's thinking, okay, there's a new set of rules that we're operating under. How much risk am I really willing to take, especially for those that are only a year or two out from retirement? So now the conversation is if we start to take some profits, where do those dollars go? And there's lots of different opportunities for that. But I think the most important thing is you do have to strike when the iron's hot. We might not stay at these same levels for the foreseeable future. So go ahead and make that change if you think it's time to do so.
David, makes so much sense. So give us a specific example under the veil of anonymity of maybe someone you've met from this radio program or someone at large where you sat down and curated a bespoke experience to help them accomplish what you just alluded to. What was their specific problem and what was the solution that was engineered?
I think a lot of people today have a similar situation, which is they're directionally correct. They've done a good job saving money. They've tried their best to avoid taxes to the extent possible. They've probably had the opportunity to put pen to paper and draft legal and estate documents. But as they're getting closer to retirement, it's not just about having the money on paper. It's about how do you actually cash flow from these investments? And we've had a good run the last couple of years, right? Markets are up, valuations are up. And I think the overarching thing that's in the back of people's minds is A, I don't want to get cut in half if this turns out to be much worse than we expected. And then B, how do I start deconstructing this portfolio? Because I need to replace a paycheck and Social Security is not going to cut it. So that comes down to one, figuring out what we need to generate every month. And then number two is how much dry powder do you want to have? Meaning, how many years of safe money do you want to set aside just in case? And if we go back to 2020 with COVID, or you go back to 2008, you needed different amounts of capital to get through those more difficult times. So to your point, this is not a one size fits all solution. This is a curated program based off your values and how you want to allocate capital into retirement. But this is a great time to readdress that for folks that haven't, because again, we're only a couple percentage points off the all-time high, and the market's now back to 21 times forward earnings. So lofty valuations, I would say.
So, David, and that's a great synopsis at a high level. Let's break it down. So, what are some of the specific actions you would use for that family? How much money would go into their cash flow reserve account? What types of specific securities are you going to use there? And how would you blend in and seek to risk reduce?
Yeah. So first, we're going to back into what's that monthly draw from the portfolio going to be. So we'll figure out what the monthly spend is, subtract out Social Security, pension income. Now we're left with what has to be generated by investment capital. Then it becomes a personal decision. As I said, do you want 18 months of dry powder safe money? Do you want 3 years? Do you want 5 years? So we're going to carve off that money. And one of the basic ways that we do that now is we ladder individual bonds so that every several months we have money maturing in portfolios. And so that you, the client, can see when your money is actually coming due so that you don't worry about it. And what I mean by that is the old way to do it was just go buy a bond fund or bond ETF, but go look at the returns of those bond mutual funds or bond ETFs over the last 5 years. It's close to zero. If you own the individual bonds, you control more of the outcome. So we're going to outline these individual bonds to make sure we have enough cash coming due, whether that's a year and a half, 3 years, or 5 years. That's part one. Part two, we have to think about is what's our new goal? And sometimes I think when you've made it, your job is just to hold on to it. So maybe your new goal is you're not trying to beat an index. You recognize markets are frothy and you need income from your portfolio. So, I always tell families I'm working with, dividends rarely go out of favor. And the cool thing about dividends today is you can blend dividends with growth themes. So the growth theme that everybody wants to participate in, I imagine most people are already participating in artificial intelligence. Think of all of those companies. A lot of them over the last couple of years have now initiated dividends. Those dividends are growing. So this is a two-part race. You've got to have the safe money early on to buy yourself time, that retirement red zone, if you will, just in case we have a really nasty bear market. But on the flip side of that, the other part of the portfolio, that's still got to grow because as you mentioned, the silent killer is inflation. We've got to grow that portfolio income over time. That's still going to require an equity allocation.
Absolutely. So, David, let's talk a little bit about, for everyone, we've only got 2 minutes to do it, for everyone who's an equity investor today, what are some of the rules of the road coming into the second half of the year, given we should be pragmatically optimistic?
Yeah, I think the first thing is you've got to go back and embrace diversification, right? We've had some issues with the most popular 7 to 10 stocks this year. And so while it may not have worked the last 10 years, having dollars spread out to other asset classes has certainly been in stock investors' favor. The one caveat I'll put on that, though, is you have to be diversified with a purpose. That's a tagline that we've used for a long time at VestGen. And what that means is diversification doesn't mean that you'd have to have a lot of names on your statement. So if you own 20 mutual funds, that doesn't mean you're necessarily diversified. Those 20 mutual funds or 20 ETFs might all end up owning the same stocks. On top of that, there might be some stock asset classes that just don't make a lot of sense. So I think you have to narrow the focus sometimes to increase the impact. So we need to be diversified, but let's not just spread money out for the sake of spreading money out. Let's spread it out for a purpose, which you now, if you're retired, have a goal. Here's how much money you need every month. And what's the way I can generate that? By taking the least amount of risk possible, where we want risk adjusted returns, not the highest returns, irregardless of risk. I think that's super important to think about. And so think about other asset classes that go above and beyond just big cap, medium cap, or small cap stocks. That's, I think, a secular trend that's starting to change now. And you talk about all the time, right? And we'll talk about diversifying your diversifies. This is what I'm talking about. There's a reason to own gold sometimes. There's a reason to own commodities sometimes. And we've just seen the benefits of that the last 90 days.
Absolutely, David. Very well said. So listen, if you want to get retired and stay retired, don't get lulled into complacency. Take action now. Take a strong stock, knowing everything you know about this economy, which is temporarily losing some momentum to maybe have long-term resurgence, and make sure you're rebalancing your protocols or rebalancing your portfolio with strong protocols. If you want some help, you can get it. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.stay-retired.com. More to come in the know. AM 560, The Answer.
It's more In the Know Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So I think there's a lesson learned. Decisions need to be data dependent. Decisions can never be made on sentiment, because sentiment, which is emotions, it changes so quick. But data is something that develops long-term secular trends. And something I have found through the platform of this radio is I think there's a lot of people who have regret specifically over the month of April. The regret can be in a number of ways. It can be one, people who sold out while the market was free falling like a knife. Regret two, people who sold out and took that cash and put it into certain products that might not be ideal long term. And David, can you spend a little bit of time and talk about the principle of timeliness, meaning there's a right time to make a decision and then there's a wrong time? And again, let data be your guide, not emotion. And then we'll dovetail that into something that you've seen a lot of, which are people overcommitted to a certain type of product in the month of April. And I don't know that overcommitments to any one product is key. David, talk a little bit about this.
Yeah, I mean, this is going to go down as one of the quickest recoveries in history, meaning the market fell and came back very quickly. And I think a lot of people know that after we had that pause in tariffs, we had one day where major stock indices were up above 9%. That's only happened, I think, 4 times in history. So if you're off by a couple of days and you sold out, you missed out on a huge part of that recovery. So I think, to your point, Craig, markets move quickly and markets tend to catch people off guard, right? Think of everybody that was so optimistic coming into 2025. Well, yeah, they were doing that after we had back-to-back double-digit years in the stock market. And we had joked tongue-in-cheek in January at our forecast meeting saying, look, if everyone thinks one thing's going to happen, the opposite might actually happen. So in April, with all of that chaos, I think the key is you stuck to your guns and were data dependent. You probably stayed in. You've now rode the wave of the market higher. This is a much better level on the stock market to make an allocation change than it was to do so early on in April. And what are examples of maybe what we're talking about? One would be market goes down. Some people think the world's burning. They go put half or 3/4 of their money into some type of annuity. Well, now you can't get out of that annuity for 7, 10, 12, 15 years, right? Was that really a good decision? A lot of that stuff has happened. You can watch the numbers in the industry. So we know people made those decisions. Now, that's not to say that all annuities are bad things, but I think the key with this is an annuity isn't a retirement plan. And if you were to rewind and go back, if you could sit down with your investment advisory team and they could easily show you that you would be covered for the next 4 to 5 years because they've laddered out all of these bonds for you, then while you still might be a little uncomfortable with all of the volatility, probably would have kept you in the game so that you can make decisions longer. And I think that's the key is lots of people have investments. Lots of people have investment products. Not everybody actually has a tangible retirement plan. An annuity is not a retirement plan, and a portfolio of mutual funds is not an actual retirement plan. That is what we offer at VestGen, is a tangible retirement plan for those that really want to be vested in their future.
No, I think that's perfect. So I think the message here is sentiment or emotion is a powerful thing. And we have never seen at any point in time in my career sentiment driving decisions as quickly as it did in the last 60 to 90 days. But if you work with firms that make decisions that are based on systematic, repeatable processes that are data driven, you knew that the flash crash of April was going to be temporary. But you also know, based on what we talked about in segment 1, that doesn't mean complacency has its place. You now need to take the rebound that you've been given and use this rebound to re-curate your portfolio so it looks proper into the second half of the year. Also, preparedness and flexibility are the hallmark of any plan. And overcommitting money into certain investments that tie you up for 10, 12, 15 years, that's a no-no. No investments are bad, but some investments are sold by people versus advised on, and you want to stay away from those. That's not something we do here at VestGen Wealth Partners. Now, David, you just talked about curating this retirement plan. Tangible plan, you said. Walk us through the components of what a plan is. Walk us through the components of what a plan is not. And let's showcase a little bit about how we do it different than others at VestGen.
Yeah, and just a fun fact or tidbit from April, right? When there were people making emotional decisions and changes towards the bottom end of that market, I believe April will go down as the third highest month for corporate buybacks in the last 10 years. So let me explain that in English. When company stocks went down in price, the companies were buying back their own stocks because they felt they could buy it back at a discount, when some retail investors were puking up their stocks for lack of a plan. So when we talk about a plan, I always talk about it in two ways. There's the whiteboard plan, and that's typically done where we outline everyone's resources, Social Security, pension income, IRAs, trust accounts. And what we do there is we try to outline year by year where the cash flow is going to come from. So January of 2026, where's the money actually going to come from? Is it going to come from your trust or your IRA? And then based off that conversation, how are we going to invest? So I think a lot of people like that visual because it's easy to get your arms around that there is a plan to handle the first several years of retirement. Part 2 of that is what I call the stress test. Technology is getting better and better. And one of the benefits of technology now is you can run so many different scenarios at the tip of your finger with a couple clicks of a button to say, what if I go 1 year earlier than I was expecting? Or what if I delay my retirement? And what if this inflation is more persistent than we had initially hoped for, right? So we have to be able to take that paper plan, which is the nice visual, and then be able to back it up with technology because things are evolving. Think of what we just went through with almost double-digit inflation the last several years. I mean, I don't know about you, Craig, but a lot of families I work with, we increase their monthly distributions. They weren't scheduled increases, but their utility bills went up, their grocery bills went up, and there has to be a way in the portfolio to adjust that. And, good thing in a lot of these portfolios, regardless of stock market up or downs, some of the strategies we run are dividend growth strategies, which have what I call a built-in inflation hedge. With a little bit of due diligence, you can buy stocks that grow their dividends 6, 7, 8% per annum. That's a great inflation hedge for a portion of your portfolio. So it's got to be, in my view, two parts. We've got to use the technology to kind of stress test the new environments, but then we have to have the plan because everybody interprets data differently. I'm a visual person. Some people are more audio, and that's, I think, what a real team does is they figure out how do you digest the data, and we're going to cater to you in order for you to understand the why behind the plan.
That's exactly right. It's all about communication. The efficacy of results is rooted in good fundamental communication. What's important for us to see the world, we want to see the world through the lenses of our clients. We want to hear the authenticity of what's important about money directly from the client's voice. No assumptions, because your family is different than the next family, which is different than the next family. And then we want to curate solutions using things that are not shiny objects, but using strategies that are tested in the trenches, supported by a systematic, repeatable process that, once again, is data-driven. And when you do that, you're able to give people the reassurance, but also the results that they need. Case in point, David highlighted families who wanted and, to be honest, needed increased monthly retirement distributions because of the higher cost of living. We're able to deliver that. And that gives me tremendous pride based on the work that everybody does behind the scenes. So I invite you to connect with us. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. When you go out to our website, I encourage you, download some of our useful guides like Trade War 2.0. You can download that for free directly from our website, GetRetiredStayRetired.com. In addition to the Trade War 2.0 guide, I encourage you to take a strong look at some of the other useful information that we have out there so you can make the most of your time. And take advantage of a complimentary visit, a strategy session with myself, with David, with one of the members of the VestGen team. We're a phone call away. 833-964-PLAN. That's 833-964-PLAN. Get retired. StayRetired.com.
More in the Know Radio. You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
A big part of getting into retirement is not about having assets. Retirement is about cash flow. It's about monthly cash flow. That's why those who have large and significant pensions have relatively worry-free retirements. But a part of getting into retirement is just a price you have to pay. The price you pay to get retired is to have awareness of the boundaries. I didn't say you have to live on a zero-based budget. Love Dave Ramsey, though, who says, tell your money where to go instead of wondering where it went. But the truth is, you need to have a great command of your cash flows. going into retirement. That's a hallmark of planning. But any retirement plan needs to have, again, that preparedness and flexibility, because there are several stealthy costs that come up and cause wrecks, absolute train wrecks for people who retire. Our job is to future-proof your retirement so you don't get wrecked. And one of those issues, David, that I want to talk about is healthcare. David, I have long said time and time again that people who make excellent choices with Medicare do just fine. But there is a big danger when it comes to retiring pre-Medicare. And there's also a big danger when it comes to certain healthcare costs that you just don't get insured. So, David, how are you working with clients across the country to help future-proof their retirement when it comes to healthcare?
I mean, I believe healthcare is probably the largest challenge for folks that want to retire before their 65th birthday, right? Before they're eligible for Medicare. So if we have, a couple that wants to retire at 60, right? We have 5 years until we're eligible for Medicare. That means we're on our own to get health insurance if it's not coming from your former employer. And as we know, every year, more and more employers cut their retiree health care. So I think the positive thing is there are avenues to get that health care, right, through the ACA. The challenge is how affordable are all those plans? I think the nice thing is with forethought today, even those that have large investment portfolios, if you spend the time well ahead of your retirement, we can manipulate your income where you might qualify for some subsidies. And then those health insurance plans do become affordable.
I got to pause. So at the end of the day, if someone's going to retire pre-Medicare, most people, we're going to leverage COBRA for 18 months. But if you're retiring at 62, that only gets us out to 63 and a half. So we got 18 months to go. And if we got 18 months to go, that means we're going to need to get some form of private health care. And everybody knows healthcare is crazy expensive. But David, are you suggesting there's a way that some people with proper planning can position with forethought and knowledge, meaning always being, what do we call it, 2 steps ahead to get their healthcare subsidized?
Of course. Yeah. I mean, those subsidies are based off your income tax return. And so with proper planning and making sure that you're diversified across the types of investment accounts you have, perhaps we show that for a year or two, you're living off cash-like investments. We can keep your income pretty low. Hence, you qualify for lower healthcare premiums to bridge that gap. But at the end of the day, depending on how long you want to go, right, the challenge is there's going to be a spend down of assets, and that's totally fine. I have no problem spending down assets, but best a family get ahead of that so that they can allocate that money most likely to a separate account so they know exactly where the money is going to come from to pay those premiums. And then I think when we do bridge that gap into Medicare, that's just a matter of doing your due diligence. And to me, what that means is you're not just asking your friend from work, hey, what plan did you take when you retired last year? I think that's a great starting spot because you always want to get real life advice and someone that's on those plans. But go out, do the due diligence, because what we often find is plans that might work well for one spouse are maybe not as ideal as the other. And so that needs to be customized for each person, depending on if they're a high or low consumer of healthcare, if they have specific physicians that they need to see that might not be in all networks. But that's all stuff that you can work with the team to help you with that. That's not something that you have to go it alone, because these are big decisions that you're going to have to make.
David, that's wonderful. And all that's related to taxes, which is number 2. We're talking about future-proofing your retirement. That's future-proofing your retirement and staying away from some of these stealthy issues. Excellent decisions on healthcare. David, TIR, taxes in retirement are the mortal enemy. I repeat, taxes in retirement are the mortal enemy. And there's this conventional wisdom among everyone who's going to retire in the future that, hey, with few exceptions, their marginal tax rate's going to go lower. What say you, and what are we doing at VestGen Wealth Partners to future-proof our clients?
Yeah, I don't see that as being the case. Oftentimes, if you're in the 22% marginal tax bracket or the 24% marginal tax bracket, you're probably still going to be in the 22 or the 24% marginal tax bracket when you retire. Look, if you're in the 37, yeah, you're probably going to go down. But if you're in more of those middle income brackets, which is where most of America is, you're going to be in the same spot. So I think there's two things to keep in mind. One, for your non-IRA accounts or non-qualified investment accounts, how efficient are those investments? I'm talking about the investments in your trust account. Do you still get phantom income tax? We've been pounding the table on this for the last 9 years on this radio show. Please do not buy investments that generate phantom income tax on your return. It will screw up your healthcare, perhaps in retirement. Number two, are you tax diversified? You might have a lot of money in your pre-tax 401k or pre-tax traditional IRA, but now is the time to probably start converting. Converting was a huge deal through December of last year, but we just got bought some more time with the current administration. Remember, we never deal in absolutes with conversions. Find someone that's going to be willing to do small conversions with you over time so you don't have to bite the bullet all in one tax year. It's more challenging to do so. But again, if you're hiring an advisor, you're putting the responsibility on them. Have them do the work. It's not your responsibility.
That's right. It's our responsibility. We take that as a charge of stewardship. So let's not just get tax diversified. Let's stay tax diversified. And every single opportunity, let's reposition to get as much as our money tax free forever. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're there, take advantage of a complimentary consultation. When you're at getretiredstayretired.com, watch all of our videos to see the mass amount of media we do, both in print, online, and certainly live radio, in addition to this station, WGN, WBBM, and of course, the major networks for television. Also, download our retirement and inflation guide. That's our inflation and retirement guide. What you need to know, how to prepare, given we currently are in Trade War 2.0. All of that can be found at getretiredstayretired.com. We've been talking about future-proofing your retirement, and that means addressing and making excellent choices for healthcare, making the right decisions to future-proof for taxes. But one of the things that I think people don't anticipate, they don't expect enough of, David, is everyone has kids. Then they become adult kids. But even our adult kids are always going to be our kids. And David, don't we see time and time again moms and dads needing to help out the second generation? And if you're not well prepared and planned, you're not going to be able to do that.
Yeah, this is why we have to build out these reserves. It's oftentimes not something that you may have done, but if your daughter or son comes calling, you are going to be the one that steps up to help them out. So let's make sure we have those reserves to do so it doesn't throw off your personal plan.
Preparedness and flexibility, preparedness and flexibility. You're listening to In the Know, Craig Bolanos, VestGen Wealth Partners, AM 560, The Answer.
Like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
Right before break, we had talked about challenges for those that are in retirement, healthcare challenges, taxes, and then also your kids. What are the things that people don't think about that might throw them off? And what are we talking about? We're talking about that phone call from your son or daughter that says, hey, mom or dad, I'm in a bind. I think I need some help. And you're really the only resource I have. You're going to be the one writing the check. So we need to make sure that we're prepared tax efficiently to get that money to the ones that you love. But I think what we were talking about, Craig, in the break too, is maybe it's not your kids. I mean, in certain cases, it could be your in-laws that need a little bit of help. And when we're putting this stuff together, how do you bridge that or broach that conversation with clients who are kind of in the middle? They might be caring with for aging parents, but also still paying their kids' cell phone bill on top of that.
Yeah, I think it's a matter of just making sure, again, the hallmarks are preparedness and flexibility. And if you're family centric, comfortable, non-flashy, have traditional values, there are times in our life that we're going to be called upon to help the ones we love and to help the ones who we love their loved ones. And there's no good answers when things come out of left field. There's no good answers when you get the phone call in the middle of the night or awkward dinner conversations come up. I think it's this. If you follow our 3 pillars of retirement income, you'll be in a position to pour into the ones that you love because you'll have the preparedness and flexibility, and you'll have already secured yourself, because it's once we have secured ourselves financially that we now have the turn to reach out and help others. I'm not sure if that's what you meant, David, but I think it's that simple at a high level.
Totally. And so I think that for those listeners out there, it's you, right? So, there might be 3 kids in the family, but there's probably one that's always going to step up. That's probably you listening to that show. And that's a responsibility I think a lot of people are willing to bear, but it's part of the planning process that we have to go through. I want to flip the script and talk about something different. I had mentioned in a prior segment, Craig, that markets are now within striking distance of the all-time highs, a few percentage points away. And valuations is one of the concerning things for markets, meaning some of these tech stocks have retraced all of their losses plus a little bit more. One of the themes that I've talked a lot about with clients this year is how can we still play these big thematics like artificial intelligence or these new healthcare endeavors, but maybe not play them through the equity markets, right? And so can you maybe give some examples of that? Because I think there's different ways to do this. The core of people's portfolios probably should be the equity exposure to those big companies. But as a complementary strategy, how can folks participate in artificial intelligence, but maybe do it through an infrastructure or a real estate play? So same thematic, but maybe different risk reward profile. Because I think that's really what people should be thinking about through the second half of 2025.
Well, David, you had my wheels turning. And the truth is this. Yeah, we believe that infrastructure, I'm going to call that out. You mentioned it. That's where my mind went. We believe that infrastructure, when it's invested well, absolutely has the potential to provide an attractive opportunity in the current macro environment that we sit in. Why? Because infrastructure, especially when it's done well, has some downside protection, because infrastructure is nothing more than essential services, critical services that are used, and that makes them resilient to economic shocks, to market disruptions. What's inherent to infrastructure is consistent cash distributions, providing, if when you do it in the right way, tax favored, risk adjusted cash distributions over time. And again, if a big part of getting retired and staying retired is following the 3 pillars of retirement income, well, David, you have to have a game plan to grow your cash flow over time. And infrastructure, again, when invested right, inherently acts as a hedge against inflation, because infrastructure has pricing power, contracted price, inflation adjustments, regulated frameworks that are already a part of it. So let's think about what infrastructure is today. David, you said what's hot? Let's be honest. Everybody wants to own data centers because everybody knows that it is data centers that power this transformation that is artificial intelligence. But you don't just want the data centers. You also want the fiber optic networks connected to the data centers. And for all the places due to easements and just inefficiency of costs, you also need to own the cell towers to transmit the data. A second layer that's there is the power consumption. You cannot have data centers if you don't have energy. Think about this. How much energy does it take to power a world-class leading data center? The entire zip code that is Lombard does one data center. Has anyone taken a look at what's happened with Stargate? Or taking a look at what's going on in Texas right now? The amount of power it takes to run a new hyper data center is the entire power consumption of the city of Chicago proper. So why wouldn't you want to be invested in heating, gas, liquefied natural gas, nuclear, clean coal, any of these things? That's all infrastructure. But you don't want to do it by buying publicly traded stocks that have the same equity valuation problems that David's mentioned. You want to do it in a thoughtful and intentional way and not just have publicly traded infrastructure in your portfolio. You want private access. And that comes through the world of private equity. And we at VestGen Wealth Partners are a fantastic gateway to help people access those private markets in thematic investments such as infrastructure to get you the power generation, the data centers, and all the components that are there. And if you don't think this is a trend, it's not just a trend, it's a secular trend that you now see public-private partnerships, not just in the US, but abroad. So you can tell by my cadence, David, I'm excited by this, and I want people to learn more. 833-964-PLAN. That's 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com.
Yeah, you make a really interesting point with infrastructure or real estate that could you go out in your 401k and buy an infrastructure mutual fund? Of course you can. But what does that own? Publicly traded infrastructure stocks. And if the market goes down 20%, don't all stocks kind of go down at the same time? We're talking about the hard assets, trying to play artificial intelligence, but not through equities because you already own those. Perhaps a complementary investment strategy, sometimes with a lower risk profile to keep you in the game. And the other thing I'll throw out there is if you go do a Google search about the market today, you're going to start seeing these comparisons to the 70s and things like stagflation, right? So persistent inflation, slower economic growth. And I think the way that folks might want to start thinking about investing is don't just look at what worked the last 10 years. Go back in history and look at some of the different asset classes that worked in those periods. How did people get through? Or maybe it's as simple as the stock market doesn't go up a lot, but maybe it doesn't go down either. It's middle ground. Everything Craig just outlined was income plays, right? That's what you want. You need income in retirement and you need growing income. And that is something that real estate infrastructure can help with because we can raise the rents, right? That's the way we think about this stuff.
Absolutely. So 833-964-PLAN, 833-964-PLAN, GetRetiredStayRetired.com. Your retirement can't rely on a solo advisor model. Your retirement needs to rely on a team of professionals coming together for the common good with multi-disciplines. That's the key. Multi-discipline professionals all under one roof. That's what we do, and we do it well at VestGen Wealth Partners.
Okay, Windy City. Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
A big part of today, we talked about so many topics. Future-proofing your retirement, making sure you pay attention to these long-term secular trends and giving you ideas on how you can diversify your diversifiers. In addition to that, we were very methodical with our themes of pragmatic optimism, diversifying your diversifiers, and making sure you understand that it's always about your tax return and it's always about making sure you take care of yourself so you can pour into family members over time. But David, I want to just talk about this so quickly. You'll have 90 seconds. Why do people not know about private credit? Why do other advisors not have access to it? And how can we use it to help listeners today achieve their retirement cash flow?
Retirement's about income. If we're looking for alternative sources of income, private credit is a great tool to have in your tool belt, right? Distribution rates, high single digits is appealing in today's market. That asset class, quite frankly, is becoming more popular. I think the challenge with asset classes like that, infrastructure, private equity, is typically those investments have only been for very high net worth families. And the nice thing about the stock market, the nice thing about investing the last several years, it's becoming more democratized, meaning it's becoming more accessible to the millionaires next door. The challenge is, does your advisory team have enough intellectual capital to get educated on how to actually implement this? Because if you're a solo advisor or there's 2 or 3 people on the team, I'm just not sure there's enough research capabilities to keep on top of this stuff. On top of that, every mutual fund player in the game now wants a part. And so while you might be offered those investments through your existing relationship, are they actually the real legitimate investments? Or are they just a nice label on a very expensive product that's going to have watered down returns? If you're actually interested in this stuff, sit down with a high-end firm that manages more than $1 billion, that does real financial planning, that has a back-end team, not forward-facing advisors, back-end team, right, of more than 15 people. Those are the folks that can help implement this if it's right for you. So just give us a call or go to our website, and VestGen Partners will work with you to put together a plan under the guise of stewardship that's reflective of your value system.
833-964-PLAN. That's 833-964-PLAN. Get Retired, Stay Retired.com. That's Get Retired, Stay Retired.com.